Interested in learning about the price-to-earnings ratio? This metric, also known as the P/E ratio, gives investors a quick way to evaluate a stock. It's a widely used valuation tool that helps you determine if a company is currently overvalued or undervalued in the market. The P/E ratio compares a stock's current price to its earnings, or profit. In simple terms, it tells you how much of a premium you are paying to gain exposure to that company's profits. Investors use this ratio to understand whether the market is placing a high or low price on a stock based on its earnings performance. In general, a low P/E ratio, around 10, suggests that a stock is relatively cheap, while a high P/E ratio, say, 40 or greater, indicates that the stock is expensive relative to its earnings. Now, let's see how you can calculate the P/E ratio. The formula is simple. Price per share divided earnings per share. Let's look at a quick example using two banks. Wells Fargo currently has a stock price of $70 per share and an earnings per share, EPS, of $5. To find the P/E ratio, we divide 70 by 5, giving Wells Fargo a P/E ratio of 14 times. This means that the market values Wells Fargo's stock at 14 times its yearly profit. In other words, at current price and profit levels, it would take 14 years for Wells Fargo to earn enough profit to fully pay back its shareholders. Now, let's compare this to another bank, J.P. Morgan Chase. J.P. Morgan Chase has a stock price of $240 per share and an EPS of $20. Dividing 240 by 20, we get a P/E ratio of 12 times. At first glance, you might think Wells Fargo is the better deal because its stock price is lower, $70 versus $240. However, the share price alone doesn't tell the full story. When we compare P/E ratios, we see that J.P. Morgan Chase is actually a better value because investors are paying a lower multiple on earnings. Even though J.P. Morgan Chase's stock is priced higher, it also generates more profit per share, making it a more attractive investment in relative terms. Now, let's apply the same concept to a different industry, technology stocks. Imagine we have two companies, Microsoft and Alphabet. Microsoft's stock price is $384 per share, and an EPS of $12. P/E ratio equals 384 divided by 12 equals 32. Alphabet's stock price is $160 per share, with an EPS of $8. P/E ratio equals 160 divided by 8 equals 20. Even though Microsoft's stock price is higher, it also has a much higher P/E ratio, 32 times, meaning investors are paying more per dollar of profit. Alphabet, on the other hand, has a lower P/E ratio, suggesting it could be the better value based on its earnings. This is why P/E ratios are most useful when comparing companies within the same industry. It wouldn't make sense to compare a bank's P/E ratio to a tech company's P/E ratio because their business models, risks, and growth expectations are completely different. A financial institution like Bank of America will have much more stable, predictable earnings, while a fast-growing tech company like Tesla or Nvidia might have a higher P/E due to strong future growth expectations. Where to find P/E ratios? If you want to check a company's P/E ratio without doing any math, you can find it on stock research platforms like Google Finance, Bloomberg or Seeking Alpha. For example, if we look up Apple, AAPL, on Google Finance, we can see its P/E ratio listed in the financial metrics section, giving us a quick way to assess its valuation. Final thoughts. 1. The P/E ratio is a simple yet powerful tool that helps investors assess stock valuations. 2. However, it should never be used in isolation, it's just one part of the bigger picture. 3. Other key factors to consider include growth potential, debt levels, industry trends. By looking at the P/E ratio alongside these factors, investors can make more informed decisions. If you found this video helpful, don't forget to like, subscribe, and hit the bell icon for more investing insights. See you in the next one.